There are 7 consumer stocks that Barron's listed as interesting names that insiders are buying into. And that's what I'm going to cover in this video. So guys, smash that like button, subscribe if you're new, and of course, drop a meow in the comments. You're watching More Money, let's get it. What's up guys, and welcome back to the channel where the goal here is to help at least 1,000 people achieve financial independence much sooner. And as the saying always goes, there's a lot of reasons an insider might sell their securities, but there's only one reason why they'd be buying them, which is to make money. And that's exactly why we follow and sort of like track insider buying. And so you can see here, Barron's reported 7 consumer stocks that are being snapped up by insiders. And one of them is, of course, the owner of Dr. Pepper, which is Keurig Dr. Pepper. And so you can see that that's the top name on this list. It's got 4 different buyers, and they bought up approximately $4.5 million worth of shares. Of course, there's Caesars, Dish, MGM, VF Corp, O'Reilly, and Pool Corp as well. But the point of this video is I'm going to focus on the Keurig Dr. Pepper opportunity, and I'm going to let you know what I think. I actually made a valuation model on the company, so I'm going to talk about the good and the bad. And you can see here, Keurig Dr. Pepper is an owner of many brands. So you can see some famous brands that they do own in sort of like the coffee space. They have Green Mountain Coffee, they have Donut Shop Coffee, Krispy Kreme, and those are just their own brands. They also license brands, but I'll go into that later. They also have a big soft drinks segment as well. So you can see that they have Dr. Pepper, 7-Up, Big Red, C+, and my favorite as a little kid, but I don't see it in the stores anymore, that Royal Crown Cola, that RC Cola. I used to love that, but they just don't sell it anymore. And then of course, they're also big in the tea and water space. You know, they have Evian water, and then they have Snapple, they have Schweppes. I think that's more on the pop side. I'm not sure why it's over here in the teas and waters, but okay. They have Canada Dry as well. Once again, probably more on the pop side, but that's okay. And then in the juices space, they also have a bunch of brands that you'd be familiar with, you know, Clamato, Hawaiian Punch, Mott's. The one that you guys might not necessarily be familiar with, and this is something that it's more aimed at kids, is the Yoo-Hoo brand. And what I have to say is, if you've never tried Yoo-Hoos, you're slipping, and you really need to get your life together and try a Yoo-Hoo. It's the greatest thing, especially when it's ice cold. Now, the question is, what's happening with Dr. Pepper Keurig as of right now? So how are they sort of developing their strategy going forward? Well, you can see here, they just actually inked a partnership to drive revenue growth. So the company said it's increasing its coffee production and inventory after supply chain disruptions impacted sales, and price increases have already been put in place to sort of tackle that inflationary impact. So Keurig is actually raising its sales guidance for the year to the high single-digit range, and they've just sort of inked a investment in Tractor Beverage Company, which makes organic, non-GMO beverages. And they announced a sales agreement with Keurig Dr. Pepper, which is aimed at young, health-conscious consumers, and $60 million in growth funding, which Keurig Dr. Pepper is the lead investor in. And so the question is, what does that mean for their overall strategy? Well, here's their overall strategy that they provided to us on their investor day. You can see that they're targeting net sales growth in the mid-single digits and their adjusted EPS in the high single digits rate. And so when I model the company out, that's kind of what I'm going to be modeling out. And the question is, how are they getting to those numbers? Like, where is this growth coming from? And largely, the soft drink space is really mature, but the in-home coffee brewing market is still growing. So you can see here that household penetration remains the core engine of growth for coffee, as stated by Keurig Dr. Pepper in their investor day. And they really believe that despite them getting a 57% increase in household penetration, they still believe that they can increase that by a rate of 2 times. And you can see that they're winning on all fronts. They're not just growing the market, but they're also growing their market share. And so in 2011, there was a 6% US household penetration of Keurigs at homes, and now there's a 25% US household penetration as of 2020. And the single-serve brewers outsold traditional brewers for the first time ever in the fourth quarter of 2020. And so why are they winning? Well, you can see here, they're winning because there's something for everyone, which is leading to fast growth. They have their own brand. So you got Green Mountains there, which is probably the most popular coffee brand, probably also Donut Shop Coffee. Those are probably the 2 big ones. In the licensed names, they have McCafe and Krispy Kreme. And in the partner category, they have, the major popular names like Dunkin' Donuts, Starbucks, Tim Hortons. You might want to throw Folgers in there as well, and Maxwell House. So there's something for everyone if they purchase a Keurig machine. And that's sort of their strategy. So the question is, they're doing so well, what are they going to do with that cash flow that they generated in the business? Well, they gave us 2 areas where they're going to allocate that cash. You can see here that their major capital allocation objective is in M&A. They want to continue to buy up brands and enter into new or peripheral markets. And the secondary options is buying back shares and paying out special dividends. Now, speaking of buying back shares, notice that they have an opportunistic share buyback program, which allows them to provide accretive growth. And here's how it works. They have a $4 billion share buyback authorization. It has no minimum purchase required, and it's for 4 years. And so this allows them to be opportunistic. And the reason why this allows them to be opportunistic is they do not have to buy the shares if the shares are somewhat reasonably valued or overvalued. They can specifically choose to only buy back shares when they're trading under their intrinsic value. And that's sort of what share buybacks are. They're a double-edged sword. You can destroy value by buying back shares when the shares are overvalued, but you can really create accretive value to the shareholders if you buy up shares when they're undervalued. And so what does the market think about this? And so it's currently trading at 21.6 times next 12 months consensus EPS estimate. And based on that earnings growth trajectory that I mentioned earlier, I personally would give this company an earnings multiple of something around 17.5 to 20 times earnings range, in that range. And so it appears to be reasonably valued at $36, with the company able to surprise on the upside with further traction in the coffee business. So you could have some upside potential here as the company sort of surprises on the upside there. But of course, you guys know that I like to model out these opportunities just to sort of make sense of the numbers. And so here's what I found. Now, even with the higher gross profit margins and lower SG&A, I'm not getting to what management is forecasting when they say that they want mid-single digit EPS growth in 2022. So there's something that I'm not seeing, and there could be a bit of upside to my valuation. But notice that I'm putting their gross profit margin up to 57%. That's high. And I've reduced their SG&A costs to 32%. Once again, that's very low. Their income tax is at around 22.5%, which is what they're forecasting. And based on those metrics alone, I'm only getting to a 1.1% EPS growth. So management must be doing something that I'm just not aware of. Either they're taking on debt to buy up some shares, or the revenue is growing at a rate faster than 7.5%. So we'll see how this works out. But this is sort of what I'm forecasting. And then what does that mean to my valuation? Well, you can see that my valuation is, I'm using a terminal multiple of 20 times earnings just to sort of solidify the point or take the point home here, that my valuation is valuing them at approximately $30 per share. Then I'm penalizing for the debt that's on the balance sheet. And so the valuation I'm giving them is around $22 per share. Compare that to the current share price of $36. And I believe that the current share price as a percentage of their intrinsic value is 166%. So it's not an opportunity that I'm looking to invest in at the moment. However, you might have a different idea. And so I actually recommend that you grab that model and change it to what you believe the company is going to end off at, and let me know what you think. And so how do you get access to that? Well, you can get access to all the models at the lower tier for the Patreons. And if you want to join us for a live epic presentation every month where my very best work is reserved for that call, you can join us at the upper tier for the Patreons. Now, the one opportunity that wasn't mentioned by Barron's, and they actually did mention in the article that they left it out specifically, is that there was a huge amount of insider buying at Nike where their director actually bought $1 million in shares, with the shares trading down in this current environment. And so I actually dissected that opportunity in this video right here.